When it comes to financial planning, there are numerous myths and misconceptions, and individuals might receive a great deal of advice from a variety of excellent and poor sources. Mistakes include mistaking high incomes for wealth and failing to recognize the significance of tax asset allocation when selecting assets. These essential insights can lead to more financial independence. Realize that income does not equal wealth. Most individuals assume that a high-paying job is the route to prosperity. Yes, it is simpler to accumulate assets if you have a higher monthly income, but one of the keys to growing your net worth is spending less than you earn. A professional athlete turning $20 million per year can swiftly go bankrupt due to their spending habits, yet a bus driver can retire multimillionaire. To escape the spending trap, you must comprehend the difference between income and long-term wealth. Obviously, income is a role in wealth, but it is not the only one. Many individuals define wealth as their current entire net worth. In other terms, wealth can be viewed as the equity on your balance sheet, or the difference between your assets and liabilities. Long-term perspective. Regardless of your salary level, the ability to accumulate money and achieve financial independence requires a long-term perspective. There are numerous factors that affect long-term wealth, and they vary from person to person. After years of study and specialty training, doctors and lawyers must put in long hours to earn a salary, but that salary does not necessarily equate to riches. With a long-term perspective, contributing to work security, pursuing a promotion, and taking actions that result in larger commissions can all be determinants for wealth and strategies to move toward financial independence. There are numerous strategies to plan long-term and amass wealth, including side jobs, private investments, and many others. They may consist of private businesses, stocks, bonds, mutual funds, real estate, patents, and trademarks. Some of these cash generators can be relied upon for long-term income in addition to your job, or as cash generators that can generate revenue during extended vacations. Evaluation of your balance sheet. Examine your own financial statement. You may already be able to rely on organic investments in your pursuit of financial freedom. Typically, this wealth generates capital gains, income, and dividends without the need for labor. The sooner you can attain complete financial freedom, the more of these assets you can afford. Obtaining a target. The real value of your salary depends in part on the amount you can invest to reach your objective of financial freedom. Setting this objective can be useful for maintaining a balanced view on money. After achieving your objective, you can successfully maintain your desired lifestyle without working. Working with a financial consultant can assist you in establishing a goal for wealth creation that enables you to maintain your standard of life without an additional income and attain financial independence. The majority of people's annual expenditures comprise a lengthy list of budget items, including mortgage, auto payments, clothing, college tuition, and entertainment expenses, among others. Create surplus investment funds. Investment opportunities can only be pursued if sufficient funds are available. At a certain point in successful investment, one reaches critical mass, at which moment the returns created by one's assets can transform one's life. A 10% return on $10,000 will only pay you $1,000 before taxes, which is hardly spectacular. The same return on a $1 million portfolio yields $100,000, which is significantly more useful yet taking the same amount of effort and study. The process of accumulating wealth and achieving financial independence is gradual and time-consuming. On a daily basis, you reduce your expenses, earn additional income, and invest the proceeds in brokerage and tax-deferred retirement accounts. With time, it begins to amount to something. Each time a new investing opportunity arises, you can act on a larger scale than in the past. This is known as compounding. Your money's interest, dividends, and capital gains begin to generate their own interest, dividends, and capital gains, continuing a successful cycle. At a 7% yearly return, this is how $10,000 a year grow to $331,000 in 50 years. Remember that taxes are very important. Not all earnings are equal. How and where you retain your assets can determine whether you are moderately wealthy or extremely wealthy. Those with little or no wealth generate a substantial amount of taxable income, whereas those who achieve financial independence generate substantial unrealized gains in the form of real estate appreciation, unrealized capital gains, and profits generated through tax-advantaged or tax-free accounts, such as a NERA or 401 kiloamperes. A physician earning $250,000 per year will likely pay $95,000 in taxes, resulting in a net income of $155,000. However, he would not have paid any taxes if he had earned the same amount through a pension plan or IRA, at least in that year. Untaxed funds can compound and grow within a retirement account until they are withdrawn at retirement. The taxes on the funds in a tax-deferred retirement account are deferred until retirement, when you may be in a lower tax bracket. However, the larger your retirement account, the greater your retirement income, and rich retirees may still face significant tax obligations. Gain command of your time. Often, gaining complete control of one's time is a prerequisite for obtaining financial independence. You may not have attained the investing objective that allows you to maintain your standard of living without an additional income, but if you have the freedom to spend your time as you like, that may be the most significant definition of wealth for you. If arriving at the office, job site, practice field, or studio each morning feels like opening a present, you are on track to achieve financial independence. You have a significant advantage over your competition if you choose a profession that you enjoy and are rigorous in managing its business side by limiting costs. You may continue to work 8, 10, or 12 hours a day for 2, 4, or 10 years longer because you enjoy the process and product, rather than because you are compelled to. Recognize that grades do not correlate with financial status. According to decades of study conducted by Thomas J. Stanley, the author of The Millionaire Next Door, school grades have little association with economic success and wealth outside of the medical and legal professions. 1. In fact, 88% of American billionaires graduated from college with a bachelor's degree or above, but academic achievement is not all that it's cracked up to be. 2. Why do parents, teachers, and counselors continue to convince youngsters that a CGPA is insufficient for success? According to Stanley, statistically speaking, this is due to the fact that these individuals are frequently not monetarily successful. As a result, they have no concept what it takes to attain financial independence and hence believe the fallacy that successful people are good students. These parents and teachers test just analytical intelligence, not the creative intelligence that is responsible for innovating, advancing society, and inventing specialized market solutions. They are unaware that the majority of millionaires wear blue jeans, overalls, or work shirts rather than a suit and tie. They consume food from McDonald's and Burger King. They reside in typical, well-established communities. Most operate their own companies. Statistically, you would have a better chance of predicting a future billionaire if you choose a self-sufficient student in shop class who pays for their own car, gets excellent but not amazing grades, has a job, and enjoys what they do, as opposed to selecting someone from the honor roll. Locate a complementary partner. Your efforts toward a better, financially independent existence will feel futile, regardless of how successful they are, unless your partner is similarly disciplined, thrifty, and investment-minded. The emotional, financial, and social toll that marrying the wrong person may have on your life will likely outweigh any career or financial advancements. Personality and psychology have a significant role in achieving great success. How can you concentrate on your career and create the life you've always desired if you're worried about your home life? You need the kind of support that enables you to take chances because you know that no matter what happens, there will always be someone waiting for you at home who loves you and shares your long-term financial objectives. Invest in less exciting niche markets. Charlie Munger, a billionaire investor, has stated that entrepreneurs can flourish if they concentrate in an underappreciated economic niche, much like animals in nature. 3. Typically, These niches are incredibly profitable, but they are unlikely to earn you any friends at cocktail parties. Create mental pictures of a multimillionaire. What do you see? 20-somethings with advanced technology aboard a yacht. Molecular biologists. Although there are few exceptions, the majority of the lucrative industries include trash management, pizza, apparel stores, trailer parks, and transportation. Consider Sam Walton's situation. He transformed a penny store in a nook of Arkansas into the world's largest retailer, creating a family fortune of more than $191 billion. 4. It's not terribly exciting to sell 50-cent flip-flops and bottles of cheap cologne in small towns, but Sam Walton was on a mission to make economical items available to the average American. He possessed extraordinary vision. Without fanfare or red carpet walks, he established his business one store at a time, or one checkout at a time, if you will. The number of millionaires comprised of business owners is unusually high. There is a fair likelihood that the largest hardware store owner or plumber in your town has a net worth that is many times more than that of the highest paid physician. This is in part due to the concept of capitalized earnings, which we have already addressed. Dr. Stanley provided an additional reason in his work. To convince their patients of their achievement, doctors are pressured to purchase status symbols, but not plumbers. Please like and subscribe.